All right, without further ado, let's start the webinar. We have with us today Paul Chu, our head of Phillip Securities Research. Paul has 20 years of experience as a fund manager and sell-side analyst. During his time as a fund manager, he has managed multiple funds and mandates, including capital guaranteed, dividend income, renewable energy, single country, and regionally focused funds. Let's welcome Paul. Paul?
Thanks so much, Roshan. So let me just share my screen. Just give me a minute. Yeah, I need to take control of the screen. Okay. Thanks. Can you see my screen, Roshan? Just wanted to.
Yeah, I can.
Okay, sure. So thanks, everyone. So welcome to our third quarter equity strategy, and thanks for sharing your precious morning with us. So what we're going to do is just run through, as typically for our strategy sessions, we'll just run through a review of second quarter, some of the macro conditions, our sector views, and also our stock picks. We release our report. We try not to make our report too thick. We always try to concise it. So it was released on Tuesday. And the report is basically titled Demand Destruction Spiral, or even Duet. So what we're trying to say is that at the current conditions right now, higher interest rates and higher inflation is kind of destroying demand out there. So when you have higher interest rates, of course, it's going to hurt assets, as we can see from the equity markets. And when you have higher inflation, it's going to eat into household budgets, and it's going to also impact corporate margins. But anyway, we'll dwell more on it as we move on to the later part of the slides. We'll start off with the usual disclaimer. I think most won't read it, but let me just guide you through. Most of the information we take, as research analysts, we take it from public markets, so we can't verify some of these data from URA and so forth, so we can't really verify the accuracy. Second thing is this is based for general information, and it doesn't take into account each attendee's own investment objectives, your financial situation. And the final one is just do seek your financial advisor regarding the recommendations that we make here in particular. Okay, so thanks for that. Let me move on to the next slide. So we're just going to give an update of how the equity markets or even assets perform in second quarter. So from this chart, we like to measure how the STI, which is the Singapore equity market on the far left, how does it compare to the other major asset classes? So you can see from here in the second quarter, so in red is how the various asset classes perform in the second quarter. So from here you can see that, but because this is measured in US dollar, you can see that the Singapore market was down 11, whereas the actual was down 9 because we measure in US dollar. But in general, you can see in the second quarter, it was everything down. Everything pain quarter. One way to kind of describe the second quarter. What was hit the most were the cyclicals. So cyclicals means the sectors that are most sensitive to economic conditions. So cyclicals also mean that if the economy were to weaken, these would be the sectors that we hurt most. So what we saw is the tech sector was hit especially hard, the Nasdaq in the second quarter. And even commodities that have been up, I think the last 1.5 years, maybe up about 50%. That also started to roll over in the second quarter. Even bonds, if you look at this, usually when the equity markets are weak, what fund managers do is you can at least hide out in bonds or especially government securities. But this time around, there was no place to hide. So even bonds, which is supposed to be the least risky asset class, also was hit especially hard. And this is because of rising interest rates and inflation, which we did not get in the previous cycles when there were worries of slowdown. But this time around, we are getting worries of slowdown and also rising in interest rates. Of course, REITs was also down in S&P, and this is basically the Asia Pac performance. One way to understand it is it outperformed Nasdaq because the Chinese tech names will outperform, I guess, the tech names in the US. If you move on to Singapore companies, so these are the performance of only the 30 SDI stocks, 30 of the largest stocks on the Singapore market. So we were just looking individually what performed and what didn't perform in the second quarter. So in the second quarter, banks were hit exceptionally hard. So like UOB, DBS were all down, as you can see from here. They were the worst performers and the ones that dragged down the Singapore Straits Times Index. The other thing that was weak was also REITs. REITs was another one that sector that kind of dragged the index. What did well was more company-specific reasons. There's really not a major team behind this. No? So Yang Zhejiang did well because there was a restructuring. No, they dividend in specie, Yang Zhejiang Financial Holdings, the financial arm. Jardine did well because of Astra. So Indonesian auto sales spiked up really strongly, and also because they have a coal mine and they also have mining equipment. Sembcorp Industries did well. I think Terence will probably elaborate later. Maybe because the spark spreads are improving, and they are growing their renewable energy. Property stocks were also resilient, and I think we'll touch on later because the property sector is exceptionally hot right now. I think most launches are cleared within a weekend, or at least 70% of it. So we won't dwell again too much on the past. So let's move on to some of the macro conditions or macro themes out there. So the first thing that we see from the data is that global growth is weakening, especially in the US. So what we see is so this is a PMI survey. So one of the reasons why we like to use this, or most market observers will use this, is because this is a survey of manufacturing activity. So it's a survey in the US of new orders. There's a bit of a lead because you're talking about new orders, and also it's why manufacturing is always used, because it's the most sensitive to economic conditions. So you can see that it is sliding, and it is sliding to one of the lowest levels since the pandemic happened. In beige is basically recession. So it doesn't mean, of course, this indicator doesn't point to recession, but it does show that it is definitely a major slowdown happening, because the orders are basically shrinking or slowing down. You've seen these episodes before, when it collapses, but it doesn't lead to a recession, but a slowdown is a definite. It's also not unique in the US. So if you look at some of the major economies, JP means Japan in red. And if you will look at GR, which is Germany, you can also see that economic conditions or industrial production activities also sliding into negative territory in these countries. So this is just wanted to illustrate that this is just not unique to the US. The slowdown is also being felt across the major developed countries too. So one of the things that's happening, okay, so this chart is basically the top 4 retailers in the US, your Amazon, Walmart, Costco, and Target. So what has happened is also the retailers has actually kind of over-ordered. So one of the reasons why you could see a slowdown in economic activity is because they've over-ordered, because when supply chain was tight and at least the visibility was demand was strong, everybody just stocked up. So the warehouse is basically full, I mean, in a layman term. So if you look at this, pre-pandemic, these 4 retailers probably had like 80 billion of inventory in the warehouse. And one easy way to think of it or to understand it. So right now, this has jumped 50%. So they probably have like 130 billion of inventory in the warehouse. So they kind of over-ordered. And now that demand is slipping, you can see from the ratio here, inventory to sales. So what happens is that when you have too much stuff, I guess, in your warehouse, you're not going to go out there and order. So as a result, this is going to cause a bit of slowdown in economic order. That's why orders you will start to slip, not only because demand is a bit softer, but because they've been over ordering. So retailers like them won't order. So as a result, you will have the after effects. Then manufacturers will have less orders. Then suppliers will have less. So this will be another trigger for the slowdown. The other phenomenon that's happening is that that because commodity prices have started to slip, a lot of retailers even when they will also want to shrink their inventory because prices are down. So you can think of it like this was something similar that happened to rubber glove makers. When your inventory is too high, you won't want to order if prices continue to slip. So you don't want to have expensive sugar in your warehouse, expensive gloves in your warehouse because prices are slipping. So you will also hold back in your ordering. So we think this is going to be a phenomenon that's going to drag down demand or at least economic activity, not only in the US, but probably globally too, because there was an over-ordering cycle. And these are typically some of the reasons why you may get a recession because of just overstocking, and now they have to destock. So when we look at some of when you look at some of the recession indicators, what we do see is that it is coming this is a monthly indicator. Of course, the daily ones you see in inversions. So this is the slide that we like to indicator that we like to use to kind of predict recessions. And if you look at this chart, so what this chart basically says is that it's again, for those who to kind of simplify it, you can just think of it like a 10-year deposit rate versus your 2-year deposit rate. So if your 10-year deposit rate FD is lower than your 2 years, this is one way to kind of understand it. That means people think that the economy is going to slow and interest rates are going to drop. And it's a very good predictor of a recession. If you look at the track record, out of the last 8 recessions, they probably predicted 7. Predicted means the indicators went negative or inverted before you had the recession in beige. So if you look at this, although on the monthly basis it hasn't inverted, but the risk is high, you can see it's quite close. And even if it doesn't lead to a so-called technical recession, it definitely does show that there's a major slowdown happening at least in the US economy. Another indicator that we use is also some of the reasons why we use is, of course, it is a helpful indicator of recessions in beige. And for this composite leading indicator, it's a very long track record. So these indicators has been around since the 1950s. So that's the reason why we want to use it, because it's been somewhat reliable. And whenever it goes below 0 or on a year-on-year basis, it's a very good lead towards a recession that's coming. Of course, not all sometimes it come very close to 0. So this indicator basically it's compiled in the US by the authorities, and it's a combination of inventory, combination of the yield curve, combination of wages, combination. It's a combination of many indicators to of course, some will argue, what is the proportion, but I guess for us it's the reliability that's most important. Okay, we always in our report we just wanted to this is our job protection prediction, that recession probability is 60%. I mean, we say this in jest, so that if anyone were to say, Phillip didn't predict recession, well, we did 60%, or some say Phillip was right, they didn't predict recession. Yeah, we also didn't predict because there was a 40% chance. So we're just trying to say that recession probabilities have really little usefulness, because it just tells me that regardless whether there's a recession or recession, with the probability, you've kind of predicted both sides. So for us, we just do it for job protection. So you can't say we didn't predict recession because we have a 60 or we didn't. So I mean, this is just something that we always find it quite laughable to have a probability there, because there's really little use of it. Okay, so even if we go to the worst case scenario and assuming there is a recession, we think it may not be deep, because we saw yesterday in the job market in the US is exceptionally robust. So the jobs market is not on the chart, but what it does say is that in the US there was 300,000 plus of new jobs, and this is double of the pre-pandemic. Vacancies in the US is about 11 million of vacancies that cannot be filled. But in addition to the strong job market in the US, what you will notice is that if you look at the blue line, the household debt in the US is very low. It's about 67. It's just a tad above Singapore. Of course, Singapore is a city-state, and we should be much higher, because now we look at something like Hong Kong. So what we're just trying to message out is that even if there is a slowdown, there will be 2 buffers for the US consumer. There's still lots of jobs out there, and most of the vacancies will shrink, but it may not mean a lot of job losses. And secondly, a typical US household could actually still rely on leverage. Of course, not a healthy phenomenon to do it, but the consumer spending may not shrink that much, because they still have the optionality to leverage up. So this is some of the reasons why we think even if there is a recession, it may not be very deep, because the household balance sheet is strong, and there's ample jobs for them to rely on. As compared to the previous recessions where there were lots of job losses and so forth. So the other thing that's happening is, I think it's pretty obvious for most of us, is that interest rates is rising. So the problem you have right now is that global growth is slowing down. At the same time, what we see is interest rates are rising, even further pressuring the global conditions or economic conditions. So this chart basically shows what is the prediction by the market. So in blue is what is the market predicting on interest rates in the US, which is the Fed funds rate. Just to dial back a bit, Fed funds rate means the interbank rate which banks lend to each other. It's something similar to the SIBOR that we have, but SIBOR we usually tag on is 3 months, but this overnight. So what it says is that right now, interest rates in the US, using the Fed funds, is about 1.5%. But by the year end, you can expect interest rates to double in the US. To the blue one is about 3.3%. And it's not only just the market predicting it, it is the Fed dot plot. So these are all the federal officials predicting what they think interest rates are going to be by 2020, end of 2022. So it's also around 3.3. So what this means is that in July, end of this month, the Federal Reserve is likely going to raise rates by 75 basis points, which is 0.75%. And you should expect another 0.75% in September. For us, our base case is that we expect them to kind of maybe pause or even slow down by the November meeting, because by then you will get data. We think that you might get data that inflation might be kind of like tapering down, or even the US economy might slow down. So that's our base case. But nevertheless, the key point we want to message out there is that don't think interest rates increase has slowed down. You should expect it to double, at least in the US. So there's going to be many more, at least 2 more big moves by the Federal Reserve by July and also September meeting. The next 2 will be November, December. So in terms of Singapore, so this chart basically links the Singapore interest rates, which is in blue, compared to the Fed funds rate, which is the US interest rates. So what you see is that there's a very tight correlation when US rates move up, because the MAS doesn't move interest rates, it's all about the exchange rate. But you can see that there's like if you do the data, it's almost like a 90% correlation between US rates and also Singapore interest rates, now depending which period you want to use. So what this means is that if the rate line here were to double to around 3, you're going to have the highest interest rates in Singapore in a decade. Of course, the pre-global financial crisis, the interest rates were higher, but we would, at least in Singapore, we could come close to it. So at least you're talking about highest interest rates in the decade for in the US, of course, and also in Singapore. Again, this is just for us, just what we want to message out for the investors. Okay, this is the last thing. Okay, so this is a bit more technical and a bit more US centric, but I guess it's good as an investor to kind of understand this. What we're trying to say is that this is the interest rate chart, and what it basically tells us is that the red line is basically what the Federal Reserve is hoping for. I mean, this is their target. The big risk for us is that because he wants to hit the target of 2%, even though global growth is slowing and we worry is that they're very adamant, that means they insist on getting the 2% in a target, then we're going to have, the market's going to have issues, because they're going to keep on rising to this goal of hitting 2%. So this is a tail risk, but we think growth will slow down, and that will kind of make them kind of become more dovish. Okay. Okay, we just have 2 more parts on macro, then we should move on to, I guess, the more interesting sector and also our stock picks. So what we see is that the supply chain is easing. So we think inflation may have peaked, or even if it's peaked, we might see inflation pressure start to roll over. And why we say that is that the supply chain is easing. So some of the things we look at is like freight rates. So this is the container rate that you charge for moving, from China. Everything comes from China. Okay, so it's from China to US to LA, or China to Europe. Pre-pandemic, these rates was maybe 2,000, then they spiked to as high as maybe 14,000. So it's like times 7, up 7 times. So right now you can see that freight rates is starting to roll over, but of course even then it's still way, way higher than pre-pandemic. Looking at maybe 8,000 there, so they are still like 4 times higher than pre-pandemic. But more important is directionally, freight rates are coming down, and it's again a sign that there's more supply and the supply chain is easing. The other indicator we use is discounts from the Federal Reserve. Again, it's a combination of multiple indexes. Some are surveys, some are the freight rates themselves. But again, they also show that the supply chain is easing, so this will be a positive. We also see that commodities are starting to roll over. So this is a CRB index. So this is a combination of multiple of commodities. Again, we're beginning to see commodities start to roll. So this is positive because the most important macro prediction or macro variable out there is going to be inflation. So it's good news that things are starting to ease. Even the mighty crude oil, we think there's a chance that it could roll over even more, because what we see is that again, predicting oil price is it's almost like a graveyard. I mean, most times you get it wrong. But we just want to show the conditions right now. At least when we look at some of the data in the US, you can see that the price of oil tends to rise with inventory. So when inventory is shrinking, which is the inverse here, when inventory is in the US for crude oil continues to decline, you can see that the oil price tends to move in line with inventories. So what we see is that actually inventory is starting to build back up again in the US. One of the reasons is that production is starting to climb in the US. You can see which is the blue line. So production is responding to the high prices. And also you see in the US, the rigs are starting to climb. There's lots of other indicators. Chinese imports of Russian crude is up about 50%. So Russian continues to produce, I guess, it's going to China. So we think there is a chance that crude oil might roll over. And again, this will be positive news for inflation and even of course for the stock market. So it's another thing that we kind of monitor too. Okay, so just one final section for me is that the good thing is that when we look at the data out of Singapore, the Singapore economy is the data is very exceptionally resilient for Singapore. The only ones that we see is weakening is that the PMI new orders. So what we always do is that we look at the PMI new orders. Again, it's a survey, and it's a survey of like how are your orders coming in, your forward orders. So when we look at the June data, the June data tends to have a very close link because there's always one quarter. So it will tell us that the GDP for Singapore will still slow even up to the third quarter, but it will not collapse like what we see here, but it will just slow and kind of stabilize. But we don't see any sharp drop. And one of the things we do is we look at the new orders because it will give us like a 1 quarter lead on the direction of the the direction of the Singapore GDP. Again, it's a bit more technical, but what we see is that it's slowing down. That means it's stabilizing. It has been sliding, but right now it's kind of looks stable right now for the third quarter. But when we look at the other data coming out from Singapore, it's still very strong. So this industrial production, you can think of it like manufacturing activity. It can be chemicals, it can be electronics out of Singapore. And it has been still very strong. So year to date, industrial production in Singapore is up about 9%. It is slower than 2020, 2021, which is the pandemic years, but it is much higher. It's like 3 times better than even the pre-pandemic levels. So although we're getting some slowdown in manufacturing activity in Singapore, but it remains very robust compared to the pre-pandemic levels, about 3%. The other data, very encouraging data we get is also the FDI into Singapore. So although we had a dip, that means foreign investors putting permanent capital, building factories and so forth, or reinvesting their profits into Singapore. It of course dipped during the recession, but during the pandemic in 2020. But you can see there's a very sharp rebound. That means investors are coming back into Singapore. Some of it could be even petrochemicals, and what's happening with the Ukraine conflict. But what we see is that it is just shy of the 111 billion record number that we had in Singapore. So the good news is that investments are coming back into the country, and this means more jobs, more economic activity, and so forth. So this is a very strong positive for us here in Singapore. Other things is, of course, jobs are ample in Singapore. So one of the things is the vacancies. I think it's probably very evident from the chart here is that the vacancies in Singapore is probably all-time high. And of course, maybe some will argue, this is maybe construction, more foreign labor reliant. But if you look at PMATs, which is we are professional managers, that is also at all-time highs. You're looking at about 70,000 vacancies out there. Another ratio, again, just to kind of emphasize the level of vibrant job market right now is that one other thing that we look at is like vacancies to unemployed. So right now, the amount of vacancies, that means available jobs to people who are not, people who are looking, there's about 2.7 to 1% looking for a job. This is probably the highest since, when we look at it, it was the highest since 1997, I mean, before the Asian crisis, or I guess the roaring 90s, I guess. So the job conditions in Singapore is very strong. And of course, this also has implications for the banking sector and the whole overall economic conditions here. And also what we see is also the visitors are coming back. Of course, you will never get it back to pre-pandemic yet because we don't have the Chinese visitors yet. But if you look at RevPAR, which is, you can think of it like revenue for a typical hotel in Singapore, which is room rates and occupancy. So occupancy in Singapore is still low, but what we see is that the room rates in Singapore is even higher than pre-pandemic levels. So as a result, on a year-on-year basis, the RevPAR, that means how hotels are performing, you could just say that revenues for hotels in Singapore have doubled, because like 159 to 72. So all these indicators just point to us that Singapore the economy here is doing exceptionally well. And the other thing that we look at is also retail sales. So retail sales is for Singapore, if you look at the latest data point, excluding motor vehicles, because motor vehicles is very volatile and we all know what's happening to COE. So a cleaner number is always to exclude motor vehicles. So we also see that retail sales is very robust in Singapore. One way to gauge it, so the most recent month, it was up 22%, which is the red line. Usually retail sales is, I mean, it's like a snooze fest. Retail sales in Singapore usually maybe rise 1 or 2%. So right now it's up 22%. What we see is that a lot of the spending is going into discretionary. So apparel is double, department store, watches, I think you can see from here. Of course, I contributed to this part, which is the food and alcohol. So you can see that it's exceptionally robust. So that's why we say that although there might be a risk of recession in the US, but economic conditions in Singapore are exceptionally strong. This one will be felt by Singtel because I think right now people are probably dining more and so forth, and it's a bit weaker for the supermarket sales. So just last two slides for me. For Singapore, what we see is also that the valuations are attractive for the Singapore market. So this is for the STI index. Valuations, you can see, I guess if there is a recession, so far the recession is on valuation. So valuations are now to some of the lows, the lower quartile low, based on standard deviation. But when you look at the earnings yield, again, this is a bit more complicated. So when you look at valuations compared to interest rates, it's actually about fair. That's what we're trying to say is that although valuations are down on absolute level because interest rates climb, so it's about fair right now. But again, from a PE basis, we think the market is looking attractive. And one way to read this is that whenever you buy at these levels, there's a higher chance that you have getting a good valuations, and it doesn't stay at the 1 minus standard deviation for long. It tends to move back to average. So there's a mean conversion. Again, this is just more statistics than, again, doesn't really predict, but what we're saying is that right now the market looks very attractive. So with that, I've managed to meet my half an hour timeline. So I'm going to move on to sector trends. I will hand it over to Glenn, who will give us a brief on the banking sector. Glenn?
Thanks, Paul. So I'll just be going through, firstly, the few highlights of the 3 local banks' first quarter results. Excuse me. So firstly, DBS, we look at their first quarter earnings. Their first quarter earnings of 1.8 billion, they were in line with our estimates, with the first quarter PATMI at 24% of our FY22 forecast. In the first quarter 22, the dividends per share was stable at quarter-on-quarter at 36 cents. However, their net interest margin fell 3 basis points year-on-year to 1.46%. But the loans growth of about 8% year-on-year, it cushioned the net interest income. So nonetheless, the net interest margin grew 3 basis points quarter-on-quarter. The fee income grew 9% quarter-on-quarter, but it fell 7% year-on-year due to weaker market sentiments. So for moving on to OCBC, the OCBC's first quarter earnings of 1.36 billion, they were also in line with our estimates. And this is despite lower than expected non-interest income, which were offset by higher net interest income and lower allowances. The first quarter PATMI is at 22% of our forecast. For the net interest income, it grew 4% year-on-year due to loans growth of 8% year-on-year. And this is despite also the net interest margin falling 1 basis point year-on-year to 1.55%. The total non-interest income fell 23% year-on-year due to unfavorable market conditions. Nonetheless, their allowances fell 73% year-on-year to 44 million. So lastly, UOB. UOB's first quarter earnings of 906 million, they were lower than our estimates due to lower than expected fee and other non-interest income, with the first quarter PATMI at 19% of our forecast. So their net interest income was up 1% quarter-on-quarter, and this is from a net interest income increase of 2 basis points quarter-on-quarter to 1.58%, and loans growth of 3% quarter-on-quarter. The fee income was flat quarter-on-quarter, while other non-interest income was down 43% quarter-on-quarter. The management's guidance of single digits loans growth with stable NIMs and provisions remains unchanged. So one more point I'd like to point out is that the high interest rates actually haven't been reflected in the bank's results yet. And I mean, all three banks have mentioned that this will only show up in the second half of the year. So we haven't seen the big growth in the net interest income, and I think we can look forward to that in the next quarters, especially in the second half of the year. So now moving on to the next slide. So we have put up this graph, and because this, I mean, most of us are concerned about the rising provisioning or the NPLs. However, we will not know exactly what's inside the bank's loans book. But we can use this graph of the nominal GDP growth versus the loans growth, and you can use it to track the excess lending. So if we see in 2008, during the global financial crisis provisioning cycle, the loans growth was outpacing the nominal GDP growth. So the 2-year CAGR of loans growth was at 25.3%, and this is compared to the nominal GDP at 20.9%. So we believe that this is indicative of excessive lending by the banks. And this is also similar in 2016 during the oil and gas provisioning cycle, where loans growth also exceeded nominal GDP growth, with the 2-year CAGR of loans at 1.99% compared to the nominal GDP CAGR at negative 1.15%. So currently, if you look at the loans growth over the past 2 years, the CAGR is at 7.5%. And this is on par with the 2-year CAGR of the nominal GDP at 7.5%. So by looking at this data, we can see that there is currently, no excess lending, and that the current cycle is more of a specific risk rather than a systemic risk. So we shouldn't expect the NPLs or provisioning to rise significantly. So that's all I have for the banking sector. I'll now hand it over to Terence.
Yep, thanks, Glenn. So for the conglomerate sector, we look at the key focus areas for the companies under our watch. For Keppel, the key catalyst in our view is the completion of the divestment of its O&M unit to Sam Marine. So we look at the current due progress and some of the outstanding matters still due to be completed. In terms of the long stop date, they expect the completion to be completed by the 30th of June 2023. We think it will be before the 30th of June. Some of the things that are still ongoing is the antitrust approvals in Singapore and also all the other relevant jurisdictions. Both Keppel Corp and Sam Corp Marine operate in many different jurisdictions. So getting approvals from these jurisdictions will take time. Other than that, they also are due to get approval from the Maritime Port Authority of Singapore. And the thing that we are watching very closely is the Sam Corp Marine EGM and the Keppel Corp shareholders EGM in the fourth quarter of 2022 for their respective shareholders to vote on the deal. Another thing that could hinder the progress of the deal is the presence of a no material adverse change, or MAC. So this no material adverse change means if in the event that one of them hit this, then the whole deal will be cut off. So the MAC means for Sam Marine is there must not be a reduction in its net tangible assets or NTA by more than $600 million. And for Keppel O&M, there should not be a diminution in the NTA of Keppel O&M by more than 600 million. One thing that we want to be very quick to point out is that this $600 million excludes the $500 million rather, that is set to be paid as a cash that Keppel Corp is set to receive. For Sembcorp Industries, for us, the key focus area for Sembcorp Industries is transition to green energy. We see this overall transition as being in line with the global energy transition, and we believe how quick and how successful they are in transforming its business from brown, which is fossil fuels, to green, will also lead to affect the re-rating of the company because of the ESG focus that is trying to kind of rebrand itself. So this transition to green is better in terms of profitability and also in terms of margins for Sembcorp Industries. So overall, it's a positive trend. If you look at the table here on your right-hand side though, you can see that in 2020, when they set the target, they had 40% of net profit coming from green energy. But in 2021, this 40% actually got shrink a little bit to 35%. Their target is 70% by 2025. But it actually shrink. The reason why it shrink was not because the renewable energy portfolio actually decreased, but because the conventional energy actually increased at a faster pace. And for 2022, we actually expect to see a similar situation. Like what Paul mentioned earlier on in the presentation. One of the reasons why conventional energy has done so exceptionally well for 2021 is because the spark spreads for both its Singapore and India portfolio has actually grown at a much faster clip than its renewable energy portfolio. But overall, despite this, the renewable energy portfolio is still growing at a healthy clip. In our next slide, on the construction sector, the construction sector, we are overweight on the construction sector as well. We see the construction sector recovery progressing well. If you look at the table here, the graph here rather on your left-hand side, you can see construction contracts awarded in 2022 actually outpacing the progress payments made. So that tells you that the construction contracts are actually rolling in at a healthy clip. For the first 3 months of 2022, construction contracts actually came in 30% higher on a year-on-year basis than versus 2021. The table here on your right-hand side also shows the construction demand for 2021 and 2022. We believe the construction demand they will keep very closely to this. Generally, the data provided by the forecast provided by BCA is usually quite accurate, 27 to 32 billion for 2022 and 2025. But we think that there's further upside for this. There's more upside from this because some of these forecasts actually don't include the resumption of the construction for Changi Airport Terminal 5, for example, which is a huge project. When we look at demand for ready-mix concrete, this is already above pre-COVID levels. So that's all for me for the construction sector. I'll hand back the time to Paul for the property sector.
Thanks, Terence. Let me move on to the next sector. So for the property sector, it is very hot. Probably this is the quote that you get from a real estate agent. So this is basically the chart of the whole property sector. Post-global financial crisis, you can see that the property sector really rallied. Then once they imposed TDSR, things was just kept sliding down until we had a soft relaxation of the seller stamp duty. Then it rallied. Then as usual, once you hit close to double digit, there was an imposition of cooling measures. Then again, the market rallied to up to December, where we had where it was almost again close to double digit increase, and the government imposed cooling measures. So right now, why we say that the property market is exceptionally hot is that since the cooling measures that occurred in December of 2021, that means December of last year, the market is really up 4% in 6 months. But when you measure the last cooling measure, which was in July 2018, it took us almost 2.5 years. You can see from this chart, it took us 2.5 years for prices to move even 4%. But right now you can see that prices just spiked up, even though post-cooling measures is just rebounded very strongly. And the 10% that you see here, if you exclude what happened in December, this is the highest. This is this is a double-digit increase not seen since 2011 when we had such a good time here. Again, and most of the launches that we've seen, some of them over the weekend can clear 70% or more over just a single weekend. So one of the reasons why property prices have been exceptionally strong is because there's very tight supply. So the blue bar here basically represents the unsold inventory. So this is units that's available for sale, be it whether on the planning stages or already built and not yet sold, which I don't think there's many left anyway. So you can see here it's about 14,000. And this is one of the lowest you've seen in, as far as the data we could extract, probably in the last decade, this is probably one of the lowest we've seen. The high was about 35,000, but because of the strong sales, you've seen that the inventory is down to almost 14. Another way to measure is the inventory to sales. That means how much stock do we have? 14,000 compared to the selling rate the last 12 months. So this red line also shows that we only have probably 1 year plus of inventory. That means after 1 year, on paper you could say there won't be much stock left. So one of the reasons is the property market is strong because supply is tight. Of course, the resale market is also strong, and the HDB prices also at record levels. And this will also pull up the upgraders market. The third reason why prices are resilient is because most of the developers have very strong balance sheets, and they're not looking to kind of sell cheaply because they can hold on to most of this inventory. There's no rush to sell because their balance sheets are strong. So that's why the new price for mass market now is 2,000 and 2,002. If you're going to bid for any land right now plus a profit margin, you probably have to sell it at about 2,002 or for the new mass market price. So that's why we are overweight for property and namely CDL, which I think Terence will kind of elaborate more. So for REITs, right now we are in transition for a REIT analyst. So I'll be your temporary REIT analyst for today. But for us, if you look at this chart, this is basically the S-REIT index. That means the REIT's value dividend yield over 10-year government bonds. Another way again to read it is like how much are we paid? Assuming we put our money in fixed deposit, that means how much are we getting the premium over our fixed deposit? So right now it's very thin. That means the higher it is means we are only getting so little additional dividend yield compared to putting our money in a government bond. So that's one way to understand it for those who may not. So what is happening now is that we think we are neutral on REITs because we think it's expensive due to the spike in interest rates. So because of the higher interest rates, there'll be like 3 pressure points for REITs right now. So because of higher interest rates, your dividend is going to be under pressure. Because interest is climbing, then it will affect your ability to pay dividends because now you have to pay more interest. Another pressure point for REITs is because the discount factor. I mean, this is a bit more technical, so apologize. But when your interest rates are high, your discount is high, it will affect the valuations of your investment property. So that's the second pressure point for REITs. The third pressure point for REITs is exactly like this chart shows, because now I can buy a government bond for 3%, so you have to give me more yield. Your 4% yield isn't worth enough for me. You need to pay me more yield. So this is another pressure point for REITs because they have to offer higher yields. You can't give me the usual 4%. It's not good enough because I can get a bond for 3%. Why must I go pay only get an incremental 4%? Especially if you're leveraged. So these are the 3 pressure points that REITs are going to face when interest rates are high. So that's why we are still neutral, especially considering that interest rates will continue to rise at least up to the year, and then maybe there will be a time where you could. I mean, maybe then the propensity to raise rates won't be so high. Then maybe that could be a better time to go back into REITs. This is my last slide. So for REITs, and basically this slide. Yeah, I know it's a bit complicated, but let me just run it through for you. Because there's a lot, because of the higher interest rates, the market is now focusing which REIT has hedged their interest rates. Hedge means you fix your interest rates so you won't get hit so badly when rates rise. So from this chart on the right, Actually, most of the REITs have actually hedged their rates at maybe 70 to 80%. So they are reasonably well hedged. That means 2/3 of the interest is already hedged. But those that have hedged the least will be from here. So you're looking at Lipo, Digital. Again, these are based on their slides. So these are the ones that would be most exposed to higher interest rates. That means if rates move up 100, 150 basis points, it's going to hurt their dividend payout the most. So these are the ones. When our previous analyst was around, so this was the sensitivity. Again, this is just for your reference. That means if interest rates were to rise, most of them have hedged, so you won't feel the impact for the next 1 to 2 years. But again, you will eventually feel it. Even if you hedge, the hedging cost is just going to go up. So there's no way to avoid it. You can avoid it for 1 to 2 years, but of course, hopefully your rental can rise to offset it. But again, these are pressure points, and the impact you can see from here that if it's unhedged is 23% impact for Ascott and so forth for FCT. Again, this is just for your reference. It depends on how much leverage they have and how much they hedged. The next slide is just on electronics. So this is the so this chart basically is a foundry capex. I'm just worried maybe some may not understand, but this is basically, you can think of the equipment, because most of the listed semiconductor names in Singapore, your AEM or the UMs, a lot of them are reliant on the semiconductor equipment. So this is basically a chart of maybe a TSMC, Samsung, and so forth. What are they spending on equipment? So this is like equipment spending is a proxy. Or SMIC and so forth. So what you see here is that 2020, 2021, 2022 has been really good years. They used to spend maybe 70 billion on equipment. Then this has, it's basically doubled. It's additional 60 billion or more. But right now we think it's probably going to stall. So right now we think growth for semiconductors will probably stall. It won't grow as much because you already had this big jump up. It probably take a few more years to stabilize before maybe there's another round. So for us, for electronics, we prefer the contract manufacturers. Maybe we prefer like the venture and so forth. Mainly because on a year-on-year comparison, someone like venture would have, because last year they shut down their Malaysian plant. So obviously you're going to get better numbers because last year you shut down, this year is open. So you're going to get growth. And secondly, the supply chain easing is also going to help contract manufacturers like venture and so forth. And although a lot of spending right now is moving from services to goods, but some our contract manufacturers like venture, they are more on medical and so forth, less so on pure consumer goods, so they won't get impacted so much. So that's why we put here prefer contract manufacturers. Again, this is just a chart on healthcare. So these are hospital admissions in Singapore. So for us, we are neutral on healthcare. Firstly, you can see that the admissions, like a better word, is the number of sick people. Okay, I guess this is one way to kind of define this chart. It's still negative. So I guess the private healthcare is losing, one way to read it is losing market share to public healthcare because these are public hospitals. Although we do see, anecdotally, medical healthcare is coming up. The specialists are fully booked. If you try, because a lot of the, especially Indonesians, are back in Singapore for healthcare. The other thing why we are a bit neutral on hospital names, I guess namely Raffles, is because they did very well because they had a lot of pandemic spending, your testing, your vaccination. So you're going to lose that this year. So it will be a year of consolidation for some of these hospital names because last year they had such a bumper of revenue from COVID-related activities. So because of that, and it will take a bit of time for medical tourism to recover, as you can see from the table. So we are neutral on healthcare. The other thing is that we are overweight on consumer. So consumer will be like maybe your Del Monte, your Thai beverage, because if you focus on this box here, you can see that because of the lockdown and then now is the reopening, consumer spending in Southeast Asia is very strong. You can see Malaysia is up 19, Vietnam 11. So that's why we are not overweight on consumer names. There are really not many. I guess there's only like maybe regional, maybe Dairy Farm, Jardine, True Extra, and also Thai beverage. But again, for consumer, we are overweight. So that's it for sectors. We will just spend more time on stock picks. So we will usually start off with our model portfolio, which is the absolute 10 model portfolio, which we try to pick our best top 10 names. The change that we did was we took out Fraser Center Point Trust. We put in Singtel because we are a bit more wary because the yields wasn't that attractive. And if we want to buy a retail REIT, our preference would be the Orchard names because we think there's more upside in rental. So when we were in the SPH briefing, you will notice that their rentals are probably still maybe 15% below pre-pandemic. So at least if we are going to buy a REIT, our strategy is to buy those that have good visibility in terms of rental reversions. So that's why we prefer Orchard rated malls. Whereas the suburban malls, the rental upside is a bit capped because they weren't that affected by the pandemic. So in terms of the performance, you can see that in the last quarter, what hurt us was the banks. So you can see that like DBS, like I mentioned earlier, OCBC was the one that pulled down. What helped outperform were like Ascott, some of the large cap names, Keppel and also CDL. So just as a refresh, when we build this kind of model portfolio, so-called or stock picks, of course, there's always going to be a risk in any stock pick that you do or any portfolio. But the key thing for us has always been, are you compensated for the risk? So we try to pick stocks where we think the valuations are cheap, that can give us at least dividend yield, and there are growth drivers to it. So this is the general principle of how we initiate stocks or even how we pick stocks. So it's basically, of course, there's always going to be risk, but if you're going to be compensated with attractive yields or cheap valuations, that's one way to kind of build the portfolio. Again, this is just our guiding principle. So in terms of performance, again, this is just for illustration. It excludes brokerage, excludes dividends, the monthly rebalancing costs. So we finally kind of outperformed the index STI here. So probably this is the monthly thing that we track. The reasons why we do this is just for transparency. And also, no point picking this stock, that stock, recommending, and there's I guess there's no transparency. If the stock doesn't do well, nobody will know. I mean, we always say we like this stock, and then nobody can actually track. But at least we want to just give transparency for investors. If it doesn't do well, we actually show you that our stock picks didn't do well. So for at least this is the historical performance. Again, this is for illustration purposes only. So for us, I guess we always like to give a conclusion of our quarter performance. So I guess we did outperform the index, but our purpose is always to get absolute returns. So I guess if I'm a fund manager now, I can just tell you that we didn't win any prize, we just won the consolation prize because we kind of outperformed the index. But again, we are only up 1%, so it's nothing to shout about, but it's just an outperformance. So again, purely for illustration. Okay, I will move on to Glenn. Hand it over to you, Glenn.
Thanks, Paul. So I'll be, for my topic, I'll be looking at OCBC firstly. So if you look at the chart here, OCBC, you can see that their net interest income is climbing. So their net interest income for the first quarter grew 4% year on year. And this was mainly led by their loans growth. And this also was translated into their NIMs as well. So for the loans growth, it was actually driven by the Singapore, UK, Australia, and the USA. So OCBC has guided for mid to high single-digit loans growth for the rest of FY22. So the other point I'd like to bring up is that their allowances fell 73% year on year to 44 million. So the total allowances fell 73% year on year and 86% quarter on quarter. And this was mainly because there was lower GPs, so general provisions of 13 million, and SPs, specific provisions of 31 million. So the fourth quarter was exceptionally high at 387 million compared to 31 million in the first quarter. So the total NPAs were also down. These non-performing assets were down 1% quarter on quarter, but up 7% year on year to 4.3 billion. So just moving on to the outlook, we can see that their loans grew 8% in the first quarter, and this is meeting the bank's guidance for a mid to high single-digit increase. And the management sees further lending opportunities in the wholesale segment, as well as sustainable financing. The mortgage pipelines in Singapore and Hong Kong are also healthy, and with more drawdowns expected in FY22. So looking back at this graph again, the management has actually guided for stable NIMs of 1.5 to 1.55% for FY22. And he has said that based on the historical data, 100 basis points increase in rates will lead to a 18 basis points increase in the NIMs. So if we were to assume about 100 basis points this year, our NII can climb about 11%, resulting in an increase in the PATMI by 10%. So if you look at the chart again, we can see that the next 2 years, we expect healthy growth, and there will also be a NIM improvement. And with earnings growth, there will definitely be growth on the bottom line for OCBC. So we prefer OCBC also due to its upside of 24% to our target price of $14.22. And furthermore, OCBC is currently still trading the cheapest amongst the 3 local banks. OCBC will also be a beneficiary of the rising interest rates, and with a CASA ratio of 63%, it is higher than UOB's CASA ratio of 56% and comparable to DBS's CASA ratio of 68%. So CASA stands for the current account savings account. And there's also potential for higher dividends from OCBC due to its higher CET1 ratio of 15.2%. And this is still the highest amongst the 3 local banks. UOB's CET1 ratio is at 13.1% and DBS's CET1 ratio is at 14%. So that's all I have for OCBC. I'll now be moving on to Silver Lake Axis. So I'll give a brief background on what Silver Lake Axis is. Silver Lake Axis Limited, it provides customized software solutions and core banking systems. So it provides the digital economy software solutions and services to the banking, insurance, payment, retail, and logistics industries. And to date, it has been the banking solutions provider for 40% of the 20 largest banks in Southeast Asia. So we'll be looking at this chart here, and this shows their total revenue versus their maintenance and enhancement services revenue. So if you can see that although the banks were conservative with the IT spend in 2020, so there was a dip in their revenue, but we were impressed at how they actually grew their maintenance and enhancement services revenue. So this maintenance and enhancement services revenue is their recurring revenue. And the maintenance and enhancement services revenue actually have the highest margins. So they have to go back to the Silver Lake for any enhancements of their existing systems. And they also managed to sustain their revenue even with the recession. And we expect that the revenue will jump due to increased bank spending as well as the new product launches. So I'll now move on to our investment thesis. So we have 3. Firstly is that they have this new product which is called Mobius, and it was launched in 2020. And this Silver Lake's Mobius cloud banking software, it allows the banks to roll over new digital products in a targeted and timely manner. So banks can utilize this Mobius platform to coexist with their existing core banking software, and this will propel them to new digital products. So potential users of Mobius includes new digital products in credit cards, debit cards, personal loans, and deposits. And Mobius is also cloud-based. So this cloud-based software avoids the need for banks to purchase and manage hardware assets. Silver Lake has also recently signed a deal with one of the largest banks in Thailand, and they are continuing to see increasing inquiries in the region. And we expect Mobius to generate about 100 million ringgit of orders over the next 2 years. Secondly, there are stable recurring revenue, which I mentioned a bit earlier. So their recurring maintenance and enhancement revenue, it contributes to about 72% of their FY21 revenue, and it grew at a CAGR of 4% despite the COVID-19 pandemic, if you can see from the graph here. And the Silver Lake's core banking software and continuous maintenance and enhancement provide a steady stream of recurring business for the group. So their core banking software is called SIPS. It provides the core accounting and compliance. And with the opening of borders and economies in ASEAN, we should expect that Silver Lake's customers to increase their IT spending to accelerate their digitalization plans to grow. And lastly, the Silver Lake also has a long track record and proven client base in Southeast Asia. 3 of the 5 largest Southeast Asian-based financial institutions uses their core banking platform, and it has also largely retained all of its clients since bringing them on board its platform. So Silver Lake's project pipeline is quite healthy at about 1.7 billion ringgit with a record high order backlog of about 450 million ringgit. And this represents about a 50% year-on-year increase. And this should keep them busy for the next about 1 to 2 years. And Silver Lake is also beginning to close more deals and is witnessing an uptick in inquiries about its financial services, market solutions, as well as capabilities. So they should be able to secure its foothold in ASEAN and look to expand into other regions. So that's all I have for Silver Lake. I'll now hand it over to Terence.
Hey, thanks, Glenn. For Keppel Corporation, the core operating segments are performing well. When we look at the energy and environment segment, we look at the infrastructure segment, and also the Keppel Capital, which is its asset management arm. Those segments are performing exceptionally well. They grew by double digits in the first quarter of 2022. They set to publish their first half 22 results, and we believe this will continue. The only laggard for Keppel Corporation was the property segment, and this was dragged down by is China business, because the China property market is undergoing a bit of slowdown at the moment. So that's the only laggard for Keppel Corporation. Otherwise, its core operating segments have been performing well for first half of 2022. And we expect this trend to continue for the rest of 2022. But having said that, we believe the Keppel Corporation will remain range bound in the near term, because we think the major re-rating catalyst will come from the successful divestment of its O&M business. And they've already announced the divestment of their O&M business. Now, they like what I mentioned earlier in the slides, the only thing that they need to go through now are some of the regulatory approvals at the relevant jurisdictions overseas, and also for the shareholders of both Keppel Corporation, its own shareholders, and Sembcorp Marine to actually approve the deal. So that we believe will lead to a re-rating of the company. We provided in this chart here, you can see the pro forma earnings per share impact of the combination. So what this pro forma earnings per share impact of the combination shows is assuming the deal was completed, and this pro forma EPS shows also the divestment of their non-performing REITs of Asset Co. Then the pro forma EPS will have increased for 2021 from 56 cents to 72.5 cents. So you can see that nice jump there. And the reason why there's this accretion in EPS is because its O&M business was actually loss-making in 2021. And one of the more common questions that we typically get on Keppel is, and Sam Marie, is why they divesting a loss business. But for the Keppel O&M is actually profitable if we exclude some of the impairments that they actually have. Because of the impairments is the one that dragged the company to a loss. Without those impairments, the company would have actually been profitable. So Keppel Corporation is profitable on the EBITDA level, but because of some of the impairments for some of the legacy assets they have, is actually a loss. But the outlook is promising, especially with all the new contracts that they'll be getting in the renewable energy sector, and also the for its own O&M business. Those have been churning. They have managed to turn around the operations quite significantly, boosted also by the higher oil prices, the sustained and higher oil prices in the last few years. Yep. So that's all for Keppel Corporation. We have a buy with a target price of $7.07. Our next topic is BRC Asia. For us, BRC Asia is a good proxy to the construction sector. BRC Asia has about 2/3 market share, so that's about 67 to 70% market share in the reinforced steel sector. And the construction sector, like we mentioned in the slides early on, in our construction sector recovery has been recovering well. The construction sector, in terms of contracts being awarded, that's in the first quarter and first half, we really see a 30% increase. And it is cheap compared to historical levels. It's trading about 6 times FY22 PE, or 8.9% FY22 dividend yield. So in this table here, you can see we provided a snapshot of their results for first half. For first half of 22, their revenue was already up 61% on a year-on-year basis. And seasonally, for BRC Asia, the second half is always stronger than the first half, but you can already see that recovery coming through, flowing through in their results for the first half. Net profit doubled in the first half of 2022, and its net profit margins also increased by 1.1%. For the second half of 2022, we expect revenue to rise at an even faster clip than what we saw in first half of 2022, and actually net profit margins to see a further improvement, which will boost their overall net profit. The reason why we expect to see net profit margins improve was because in the last 3 months, we've actually seen steel prices actually decline steadily by about 20 to 25%. So this will reduce the onerous contracts in their books and boost its overall profit. So by all estimates, FY 2022 will be a bumper year for BRC Asia, and shareholders will be rewarded with this, we think, a very, very good respectable dividend yield of 8.9%, which kind of like what Paul mentioned, which kind of captures have a nice balance between risk and reward as well. So we have a buy rating on BRC Asia because of its strong market position as a proxy to the construction sector recovery, as a market leader in the sector with a target price of $2.26. Our next topic in the construction sector is Pan United. For Pan United, the first half results we expect to be very, very strong also compared to FY21. We expect a 25 to 30% uplift from FY21 levels, and that's because RMC demand for the first half of 2022, according to BCA estimates, are already above pre-COVID levels. You can see in this chart here, it's not exactly very clear, but on a year-on-year basis, RMC demand is 5% higher versus FY21. And we like Pan United because Pan United is a market leader in the construction sector, is 40% market share in the sector. And other than the ramp up in improvement in the construction sector, is also good. We believe for both BRC Asia and Pan United, it will continue to see a sustained recovery because the government has really ramped up the number of BTO flats. So for perspective, HDB has announced that they are ramping up the BTO flats from 19,000 to 21,000 previously to 22,000 to 23,000 BTO flats going forward. This ramp up in supply of BTO flats is in response to the rising demand because of the shortage in the market. I think Paul, he showed the low inventory in some of the earlier slides in the market, and there's really this need for property. And so HDB is ramping up supply to meet this need. And this surge in supply will benefit companies like Pan United, especially because of its market share. For perspective also, this 23,000 is also higher than pre-COVID levels. The pre-COVID levels, BTO flats was actually around 15,000 to 17,000. So you can see really that kind of uplift from what it was before COVID, 15,000 to 17,000 HDB flats and 23,000 HDB flats that HDB is guiding for the next 2 years. So overall, we have a buy call on Pan United for being as a proxy for the construction recovery, and as a market leader. We have a buy call with a target price of 68 cents. In our next call, city developments is part of the absolute 10. For city developments, we think that there are two major tailwinds that will benefit city developments. It benefits from the property boom, because of the supply crunch, and early on we had slides on why the property sector is prime for recovery. So we think CDL is set to benefit from this property boom with the prices rising because of this shortage, which will benefit city development because it's the largest property developer. And the second tailwind, which we'll elaborate about later on, is because of its hospitality portfolio. So if you look at the residential units sold in Singapore in our slide here on the left-hand side, you can see for FY21, we are already seeing some of these come through. In FY21, total number of residential units sold in Singapore by CDL was 2,185. You can see this recovering very, very strongly from FY 2020. And in terms of sales value, this more than doubled in FY 21 from about 1.8 billion in terms of total sales value to about 4.3 billion in terms of total sales value. In terms of the new launches, despite some of the cooling measures that they announced, you can see the property trends remain healthy. If you look at the property launch in the first half of 2022 for city developments, Piccadilly Grand, which is a integrated development at Farrer Park. So that is considered. This integrated development is considered a OCR region, and you can see that it came in at 77%. So despite the cooling measures announced, with an average ASP of $2,150 for an OCR region. So we think that signals that the mass market remains healthy, and the demand remains healthy despite the cooling measures being announced. Tengah Garden Walk, EC, and the residential component of Fuji Xerox Towers development is also slated to be launched in second half of 2022. For Fuji Xerox Towers development, we expect this to provide a healthy uplift to the overall margins for CDL, mainly because for city developments, they actually Fuji Xerox rather, it actually benefits from the CBD redevelopment scheme. So they can actually top up this. They don't disclose the amount, but they can actually top up the plot ratio, and we believe the launch will provide a healthy uplift to its revenue and overall margins as well. In our next slide on the hospitality sector, this is my last slide. Through its wholly owned subsidiary, Millennium and Copthorne Hotels, the group has over 130 hotels globally and over 40,000 rooms worldwide. So we believe this hospitality rebound, and you can see the hospitality rebound actually already showing in their first quarter 22 results. You can see RevPAR for first quarter for Singapore is up 72.6%. In some of their markets like London and New York is really up. Is also up. The only laggard was Australia-Asia, and the drag was because of the COVID-19. But overall, the overall trend for hospitality is a positive one, and CDL is set to benefit from this. They have, because of the 40,000 rooms that they own worldwide. For perspective, Ascott REIT has 70,000 rooms worldwide. So city developments, you can see they have a healthy level of rooms to take advantage of this hospitality rebound. So overall, we have a buy rating on CDL with a target price of $9.19. So that's all from me for CDL. I'll now hand back the time to Paul.
Thanks, Terence. So we move on to the next few stock picks. The next one is Ascott Residence Trust. A bit of background. So Ascott has probably like 17,000 service apartments across the world. Most of it is in Asia, 60%. So some of the reasons why we like it is that, as we mentioned, we're a bit more cautious on REITs, but for Ascott, because we do see the rebound, as you look from this chart. So this is RevPAR, probably pronouncing it wrong, but it's like RevPAR, no, it's like basically revenue. You could assume the service apartment revenue. So you can see the recovery is happening. And why we like it is because there's still a lot of room to go back to the pre-pandemic levels. So because of rising interest rates, what we want is visibility of rental growth. And what we also think, the second reason is that we think there'll be at least 3 phases before for recovery in travel. So right now, what we are experiencing for international travel, what we think is that the first phase will be leisure travel. Except me, I haven't gone anywhere yet. But the first phase is going to be leisure travelers, going traveling across. The second phase will be more business travel that will spur hospitality, and the third phase hopefully will be China opening. Of course, probably only one person in the world knows when is the date, but that would be, we think hospitality has three ways to ride. So that's why we are positive on hospitality. The third reason is, of course, the yield is reasonable at 3-4%. As you sit down and wait for hopefully these three ways of hospitality to recover. And the other third reason is that they probably have like almost 200 million of capital gains that they have not distributed. So one unique thing for Ascott Residence Trust, probably may not be so well known, is that they managed to sell a lot of properties around 40-50% above valuations. So you either sack the valuer or there's a lot of hidden assets in that. Because what we've seen is that they managed to, a lot of their assets are well located in city centers, and some of it, of course, if you can sell 40-50% means the person who's buying it is, they're going to use it for development purpose. So there's a lot also hidden value in their assets, and that's why they managed to, I think, it's about 200 million of reserves that they can distribute. So these are some of the reasons why we still like Ascott Residence Trust amongst the various REITs, despite the interest rate pressure. The second stock that we like is Del Monte. Now, firstly, Del Monte is, I think it's mainly canned fruits, and some of the reasons why we like it is it's trading at 5 times PE, which is very, very rare for a consumer stock. Most consumer stocks, high teens or 20%, 20 times PE, and they're also paying like a 6% yield. So for us, why we like it is mainly that basically for Del Monte, there are two parts of the business. There's the US and there's the Philippines. But the one that's driving a lot of growth, I think in the fourth quarter results, recent results, their earnings was up almost 40%. One of the reasons is because of US, and one of the reasons is because you see from this picture here. So they've since the new management came in, they shut down a lot of factories because they weren't a brand name. When they took over, when the Philippine, Del Monte Pacific, the Lisco bought over the US, they were mainly just producing products for other retailers. I'm not sure why, but what has happened is that they shut down factories, then they begin to innovate. So you can see from right now, they're not only selling canned food, so they're selling fruit in a cup, they're selling broth, they're selling a lot of new products like sandwiches, a lot of healthy products, purposeful snacking. So that's one of the things why they did well in the US. The second thing is they're undertaking price increases. So I think they did like 3 to 4 rounds of price increase. So they don't do like very huge price increase. They'll do small incremental price increase to offset the rising materials. But you can't really see, because when you do it incrementally, it won't be so visible. And they're also moving to new channels. Now, in the past, they were just producing things for under Walmart's brand, those. But right now they're building their own brand, and then they're also selling into convenience stores, into quick service like fast food chains. So they're also moving, expanding the channel. So that's why you get this company-specific reasons why the growth is so good. The other reason why they're doing well is because of food inflation in the US. People won't be dining as much in restaurants, and so they're moving and they are going back into dining at home and cooking at home, and they want more premium products. And also they're choosing the better canned food, I guess, the more premium range, and that is also helping the US. So for the Philippines part, so again, there are two parts to the business. For Philippines, the strength is the market share. I think it's like 93%. You can see from here, 86. Basically, they are the market, and they dominate the shelf. Probably the competitor is probably at the bottom part of any shelf. But that for Philippines is a bit more challenging. It's almost the reverse of US because of food inflation. They're being impacted by some of the canned mixed fruit, packaged pineapple, because these are a bit more discretionary items. So food inflation means then the Philippine consumer isn't spending so much on these items, which are more occasional, more for special occasion kind of consumption. So Philippines might be a bit weak, but we still think the US will be very strong. One of the reasons why investors were a bit hesitant, and firstly, we are the only broker that covers them. The bit hesitant was because when they acquired the US business, they took on a lot of debt, and that's why they have like almost $1 billion of debt. So people are a bit worried, but as they turn around, the cash flow improves. The other final point is the other driver to earnings growth would be refinancing of the debt. So once they acquired and the leverage was high, they had to pay very expensive. The debt was as high as 12%. But right now they managed to refinance it down to about 5-6. I think it's about 5-6%, and then they save like maybe 20 million of interest a year. And this is big because this company makes like 100 million. So the other growth driver for them, apart from price increase and US, is also lower cost of debt. So that will be another growth driver for this company. Move on to ComfortDelgro. So we've been recommending this stock for almost a year, and I guess that's the problem with being too transparent. So now everybody knows this is a bad call because the share price didn't move for almost 1 year plus since we put it in the model. Hopefully the share price will move before, if we ever go into some physical presentation, hopefully this thing will move by then, so that we don't get more questions. At least I don't get more questions on this. But some of the reasons why we like it is our proxy to the whole reopening in Singapore. And we are beginning to finally see the rebound. So this is the number of people that use the SBS transit rail. So you can see in the latest month of May, it jumped to 900,000 from a year ago, 600. So you're getting this big 50-60% jump in traffic. So that's the reason why we like it. It's a big reopening play. And we like the operating leverage because when more people use the transit, it all goes to the bottom line because it's not that they're going to spend extra money for 1 or 2 additional passenger. So we like the operating leverage because any additional revenue goes to the bottom line. The second reason is because of the high fuel costs and so forth. Is also helping the taxi fleet, and they're also reducing the taxi rebates by charging more for people when they use the app. So and also for ComfortDelgro, despite the pandemic, their balance sheet actually strengthened. They were net debt, and then now they are net cash of I think about 300 plus million roughly. So that's why we like it, because it's going to be and the stock is around 30 to 40% below pre-pandemic levels. So this is the reasons why we like ComfortDelgro. Mindful of the time. So the other one is I think we mentioned this before, HRNet. HRNet is the largest recruitment agency in the region. So we like it because the ROE is high. Depending how you calculate, it can be as high as 50% because they got so much cash in the balance sheet. The reason why we like it because there's barriers to scale. So it's easy to set up a 1 or 2 man recruitment shop. Anyone can do it, but to have 700 recruiters under your brand, that is very difficult. And when you are so large scale, you get you get premium pricing, and you also get the bigger corporates to deal with you. So that's the structures team, and of course they got 300 net cash. And this chart basically shows the amount of cash they collect. So the business doesn't need much capital. The fixed assets only 1 million, but they continue to generate roughly 60 million a year in cash flows. So we like it because the model, they spew up a lot of capital. They don't really need much. And also right now, they're also spending like 30 million in share buybacks. And 30 million is a lot for them because the volume's a bit thin, right? So it's about almost 6 months of liquidity. And finally, the reason why we like it, the final reason is because of the environment right now. Because right now, of the difficulty to find workers, a lot of corporates are looking for recruiters to help out because it's so hard to find people. The hiring manager can't be like spending hours trying to interview and look for employees. So they're working very closely with recruiters to find headcount because it's so hard to find. So that's why they need more recruitment. They're working closer with recruitment agencies. And also for HRNet, there's 2 parts. There's the permanent hire, the headhunting, and also the flexible hiring. So flexible hiring is also doing well now because, as we mentioned earlier, retail sales is rebounding, and also because there's difficulty in finding workers, a lot of companies have to shift towards a bit more flexible hiring. I think you can ask any corporate that does business they are thinking hard because you cannot find, and also there's a lot of quota system for services industry. Not quota, I mean the dependency ratio. I mean the number of foreign to local, there's a ratio there. So as a result of that, they have to rely, they might have to use more flexible hiring. So that will also benefit HRNet. The next one is Singtel. So Singtel, okay, we all know that telcos is such a mature industry, but what we think is that we expect a rebound in their earnings or EBITDA. So this chart is basically the EBITDA for Singtel, Singapore, Australia, India, and so forth. So the rebound is coming because roaming revenue is rebounding, and roaming is a pure profit business. So especially for their Singapore operations, now that the borders are open, of course, it will take time to climb because the borders only just open, and China is the big market, so it will take time. But at least we know directionally there's this big tailwind for them. The second thing that will help earnings is the emerging markets. So do note that in emerging markets, telco spending is not like us, and we're all forced to, every month we pay a fixed charge. But over in emerging markets like Indonesia, Thailand, it's a bit more discretionary because it's prepaid. So when their incomes are better, they will, I know it might sound a bit funny, but they actually will speak more because they have more income, they can top up more, and then they can spend more. So this is one of the reasons. And one of the main growth drivers here is also India. So India, what's happening is competition has really narrowed down to a duopoly. There's only more or less 2 operators here. The third one has a very weak balance sheet. And a lot of and that's why the prices has improved, and Bharti is the only pure play listed. Well, for the only thing right now for India is the 5G bidding, which we think will be more rational because there's technically only 2 guys are going to bid. I guess the third guy is like a bit limping because it doesn't have a strong balance sheet. So that's why we like Singtel. And the third reason is there could be some restructuring, hopefully, if they could maybe divest and monetize some of their assets. Okay, these are the last 2. Again, these are a bit very small cap, but we just to mention so that we don't keep on repeating the same names. So the other stock that we wrote initiate was Uni-Asia, but do note at the bottom, as you can see, this is a paid research. So we did receive compensation from the company. But one of the reasons why dry bulk, so dry bulk is, this company operates like 10 vessels of dry bulk. So dry bulk ships, they're not container ships, so they carry things like iron ore, grain, anything that's not a container, can I say it's a dry bulk, apart from liquids. So they do a lot of dry bulk. So one of the reasons why they're doing well, the freight rates are, I think, up almost 80% in the first quarter, is because of this chart here. So this is probably the most important chart. The only chart you need to know on dry bulk is because the orders are very low. So this chart is the amount of vessels being ordered compared to the fleet. So let's say there are 100 vessels that that's being used right now. So there's only 7% being ordered, which is very low considering I think 15% is more than 20 years. And if you look at the historical chart, it used to be as high as 80%. So since then, when all the new ships come in, they've been suffering. So we think there's a supply crunch because most of the shipyards are now busy with container ships, number one. Nobody wants to be a dry bulk. The value is low, and so less profitable for them. So they rather do containers. And you'll notice the latest announcement, the Yang Zhejiang, most of it is all containers. The second reason is because of the fuel. There's a bit of fuel regulations, there's uncertainty. And the other thing is supply is also impacted because a lot of ships are stuck in ports. Because of the high fuel price, a lot of vessels are slow steaming. That means they're going very slow to save fuel. And as a result of that, most of the ships are now at sea, and it kind of cuts down the effective supply for vessels. Again, this is just another name, but do note that there's compensation for this. Okay, this is my final one. Of course, this stock is a micro cap. We don't even have official recommendation for this. And I hope nobody complains about why you recommend this because there's no volume. But the only reason why we're doing it is because this stock is trading below their net cash. So the blue line is the share price, you can say, and the red line is the cash in the balance sheet. So although the cash continues to grow, but it's still below, so like 13% below. And what this company does is a freight forwarding company. It's a micro cap, but for us, it was just a very few companies trade below cash. So this is one of the few of them, and freight rates are doing well not because of the supply conditions. So what they do is freight forwarding, which is basically a customer wants to deliver products from maybe from the ship components from here to Taiwan, then you help them do the end-to-end, and also they also do wholesale. So they got like China wholesale means maybe you book slots in the container vessels, and then you sell it to other freight forwarding. So again, this one is because it's very thin volume, but just that it's below cash. So let's give us the conclusion before we move on to Q&A. So some of the conclusions is that the current environment is that there's a demand destruction to it because high inflation and interest rates. The good news is that we think the fourth quarter looks interesting, could be a bullish scenario because we think the Fed might pause or even slow by the November meeting. And regardless, the Singapore economy is very resilient. Most indicators we see are still very strong. These are the sectors we favor, and this is our target for STI. Finally, this is our research team. And do note that because we are going to launch P3 Poems 3, and we are going to, good news for you, but may not be so good news for us, is that because there's going to be a community page. And what community page means is that anyone who's a Poems customer can ask the analyst questions. Hopefully you all ask the other analysts more, but anyway, because of that, we will have you can have direct access to all the analysts if you're in our community page, and you can just ask us any questions. Hopefully we get it right, but anyway, this will be a new feature in our new Poems mobile, and I mean, do look out for that. These are some of our research at, this is our telegrams, this is our podcasts, and I think we can move on to Q&A. I think I will just end slide. Okay, thank you everybody. Okay, we'll move on to Q&A.
Yeah, let's start the Q&A.
Okay, for Q&A, we will, sorry, I was on mute. We will just try to take on those that have the most votes. So apologize if we didn't take on everyone's questions. We will try to do our best. So let me just read out the questions. Hi, Paul, sharing all the data shows downturn all the way towards next year. My question is that, is it wise to let go what you hold now and buy back later, or keep holding and wait to the upturn? For me, we rather keep what we own, because number one, we think like we showed you on the valuations chart, the valuations have really come down to some of the lows for the last couple of years. That's number one. Number two, if you look at the US market, they've already corrected from peak to trough about 30%, especially for NASDAQ. And this was the amount, I mean, roughly the amount of correction when we had the recession fears when the pandemic happened. When the pandemic happened, the US market also dropped about 30%. So we've already kind of experienced that. And believe me, recession is more or less kind of priced in. Everybody knows, everybody keeps on talking about recession. So that's why we prefer to hold. And because you want to hold, because valuations are attractive and you're being paid, I mean, depending what stock, maybe 4 or 5% dividend yield, I guess you're being paid to hold. So that's the reason why we think, for me at least, I would rather hold than try to time this thing. So at least I know that the yields are attractive, valuations are attractive, and I rather hold than, again, going back to the question, to sell and try to buy back. And usually, once you sell, psychologically, we hardly buy back, because if you sell and the price move and then you'll be waiting, no, I want to buy back cheaper. So psychologically, there's always that hurdle to buy back. Yeah. But anyway, thanks for the question. I think our next question, I think Terence can help out.
Yep, sure. Yeah, so the next question is, will you consider SETS for reopening play? The activities at Changi Airport are picking up. Yeah, so SETS is we have no rating on SETS at the moment, but SETS we think SETS is a good proxy for the reopening play, because of it has almost it has a monopoly on the gateway services. So it's a direct beneficiary for the pickup at Changi Airport. We also prefer SETS over the airlines, because it is agnostic to the pickup in the sector. You don't have to worry about people choosing another airline or like SIA or another airline. You just, as long as they go through Changi Airport, then SETS will benefit. I think the next few questions are on the banks. Yeah. Yeah, so the next question is on the construction sector. So regarding construction sector, are you not concerned that the rising cost of labor, materials, etc., would eat into the margins of construction stocks you highlighted? So yes and no. The Pan United and BRC Asia are both profitable. And one thing that we would note is that for FY, during the COVID years, financial year 20 and financial year 21, they were also profitable. So for such materials provider, this construction materials provider, their margins are actually very, very thin. So for them, they cannot absorb too much of that margin. So most of these costs are actually all passed through to the developer or to the end consumer like HDB. So HDB, for example, they have a variable pricing in the contract. There's a fixed and a variable component. So when there's a price increase, they actually pass on these costs to them. So in terms of profitability, they are actually okay. The next question: do you think shareholders of Sembcorp Marine should accept or reject the deal? Now we get this question a lot. I think there's probably one other question on this, but we'll take them together. For Keppel Corp and Sem Marine, they have been trying to come together even since year 2000. So in year 2000, Keppel Corporation and Sem Marine explored merger, but the deal didn't go through in year 2000 because oil prices was surging then, and so both companies didn't see an impetus to come together. Obviously, the oil price collapsed in 2014, and the down cycle that has followed since was then the impetus for the two companies to come together. So for the deal, in terms of the deal on the table together, I think it's the best deal on the table at the moment. If they were to unwind and try to do it again, then you may end up not having a deal that can please everybody. So for them, for Keppel and Sem Marine, it's more important to take a longer term view in terms of the kind of revenue synergies and the cost synergies that is on the table, and focus on the longer term. So we don't have a recommendation on Sem Marine, but overall we think that given the circumstances that they are facing, the deal on the table is probably the best deal for shareholders for both sides. Let me just run and see if there are others. Would like to understand on Keppel divestment, O&M. After divestment, Keppel valuation will be higher or distribute the divestment in special dividends. So the divestment will be based on they will divest the shares to the Keppel Corp shareholders. In terms of valuation for Keppel, it will likely drop, but we believe there will be a re-rating for Keppel because they will have divested one component, one loss-making component from his business. Yeah, so I think I'll pause here and maybe hand over the time to Glenn to take the next few upvoted questions. Glenn.
Thanks, Darren. Okay, so I'll take the next few questions regarding the banks. So, I mean, the first one I see here, the most upvoted one. Hold on, give me a minute. Hi, if interest is moving up, why are local banks stock price based on your chart downward trend? Okay, so I think one of the main reasons is that the recession is being priced in to the bank shares. So although the interest rates are moving up and the banks will definitely be able to benefit from the rising interest rates, and this would sort of go into their NIMs, their net interest margin, as well as their net interest income, and eventually going into their net profits. But there are other concerns. Firstly, is that with inflation, there will be fewer. I mean, people are expecting that might be fewer. The loans growth will be slower. Sorry. So this will of course affect their bottom line as well. So this is that's why there's a downward trend. I think there's also another question that is related to this. Bank share prices are falling despite increasing interest rates. Will they increase once the results are announced? Yeah, so I mean, again, to reiterate why the bank share prices are falling. It's because despite the increasing interest rates, they are not performed. The results aren't showing this increasing interest rates. And as I mentioned earlier, all the banks actually only expect the increasing interest rates to reflect in the second half of the year. So the first quarter and the second quarter, we won't see it so much being reflected. And the next results will be the second quarter, so the first half. It would still be healthy, but it will be more stability than the strong growth from the rising interest rates. So we should only expect this to come in the third quarter or maybe even for the full year. Then I'll go through a few more of the bank questions. Okay, there's one more here. Hi Glenn, has the 3 bank stock price bottom? It's quite hard to say whether they are bottom, but I think even maybe Paul also has mentioned earlier that the prices are the lowest in the last couple of years. So this is like pandemic prices. So it's quite hard to say whether they are bottom. But I mean, looking at the outlook, the banks are able to sort of bank on their increasing interest rates, and we have seen that they have raised their interest rates for their housing loans. So, yeah. Okay, there's another one about UOB. So I'll just briefly go through UOB. I'll just talk about their outlook. So for their PATMI, we expect that their profit should continue to grow into the rest of 2022. And this is mainly on the back of the stabilizing margins, stronger fees, as well as lower provisions. We also expect their net interest income to expand about 14% year-on-year, and we also continue to expect credit costs to come in below their guidance of 20 to 25 basis points. And there's mainly earnings upside from write-backs of their management overlay of general provisions. However, their management has said that they are being conservative, and their intention is only to write back some, but not all of their general provisions during the second half of 2022. And for their loans growth, their asset quality is expected to stabilize, and the management also expects to continue to see strong demand for loans as the cross-border activities pick up. So ASEAN loans growth is expected to be higher, but they do see some slowdown in Singapore and North Asia, as the growth so far has been skewed towards the developed markets, as the ASEAN economy remains muted. But they expect this to change, and we can see with the rest of the ASEAN economies reopening. So we should see continued growth in the ASEAN economy. And they also have guided for mid to high single-digit loans growth for FY22. This is for UOB. Let me look through and see if there's any other upvoted banking ones. Okay, I think I'll just hand it over to Paul.
Okay, all right. Yeah, you look through and then you see which one. So let me just take this one. It's the most highly voted. Given that palm oil prices has corrected by more than 20% from recent high, what is your outlook for Wilmar? Thanks. Okay, this answer is going to be a bit long, but just bear with me. So just as a refresh, not everyone may know who Wilmar is, but so Wilmar has roughly 3 parts to the business. There's a YKA, basically they sell edible oil in China. There's a soybean crushing. So you take soybean, you crush it, and then to feed the hogs in China. So that's, roughly. And the third one is they have palm oil refining and a bit of plantation. So for us, we think Wilmar looks interesting. We don't have an official recommendation of a buy, so at best we can say it just looks interesting. So if you look at the various 3 businesses, if you look at the first one, which is the listed YKA, Yihai Carry Awana, they sell edible oil. So this part might do well because they've been under pressure because they couldn't pass on price, but I think they've been raising prices a few times this year. So we think you could see a recovery in edible oil because raising prices in China is a bit sensitive because this is edible oil. Right? So we think Yihai will do well because edible oil. Secondly, so the second part of the business, which is the soybean crushing, which will sell to hog farmers, I think that should also do well because you see the volumes are picking up and the hog prices are also recovering. So this part will also do well for Wilmar. The third part, which is the refining, that will also do well because when you're refining, low palm oil price will help you, especially now in Indonesia where there's just too much. So what happens in Indonesia is that once you harvest the palm oil, you normally sell to Wilmar because they're the biggest refinery out there. So now that the prices are low, there's too much inventory, they will benefit from that. And also biodiesel, because of the high fuel oil price, they could also the production for biodiesel. So on paper, it looks like Wilmar looks, all three divisions are going to do well for the next few quarters. I mean, because they don't have that much plantation. So that will be a drag, but the other divisions are doing well. One final division that may look interesting that they are building up in China is a centralized kitchen in China. So centralized kitchen is that basically the game plan here is that in China, when you go to a restaurant, you won't be seeing many chefs. Most people will be just mixing things because there's so difficult to find headcount. So when you go to a restaurant, a lot of the ingredients will be supplied by a central kitchen, and the chefs will be just mixing. Of course, I'm taking it to the extreme. So what they're doing is that they're building central kitchens across China. So once you build a central kitchen, there are multiple ways to generate revenue for them. Firstly, there's logistics. You make money from delivering all these ingredients. Secondly, you can collect rent because there could be ghost kitchens there. Thirdly, you're also selling processed food. That means not only do you take the ingredients, you might make into ready-made meals for them. I mean, so that would be a third. And also, of course, you're selling, they're very strong in flour, sugar, edible oil. So this could be a new big business for them. And when you talk about Wilmar, you're talking about huge scale. So they'll build it across China. So this could be an interesting earnings driver for them. So in a nutshell, Wilmar looks interesting. Okay, sorry, it's a very long answer, but okay, let me just move on to the next one. Going forward, Fed is increasing interest rates. How do you think it will affect Singapore property market or stocks? We don't think the impact will, at least in the very near term, unless interest rates double, triple, then maybe it will impact everything. But one of the reasons is because the ability to get financing. Because right now, property launches, probably 80% locals. Again, there's no hard number, maybe 60-70% of it could be first-time house buyers. And most important is whether the banks want to fund you. So if you look at the way TDSR is computed, so TDSR is already assuming 3.5% interest rates, even when it started from the very beginning. So the eligibility to borrow had already incorporated high interest rates. So that's why we don't think, at least in the beginning, or maybe unless interest rates don't really spike up, then of course all bets are off. But in the meantime, I don't think for second half, it's going to impact property market or even the property stocks, especially the supply is so constrained right now. Yeah, so that's why interest rates won't have an impact in the near term at least. Glenn, have you taken this banking sector?
Yeah. I'll take the banking sector one.
Okay, all right, thanks.
Okay, thanks, Paul. So there's one more question. What will be the outlook on banking sector if we expect a stagflation, recessionary macro environment? So with this recessionary macro environment and stagflation, what will most likely happen is that we will see the loans growth dip. However, they are able to buffer it and with the higher interest rates. So this will also increase their NIMs, but their loans growth might go down. So it will sort of stabilize, I would say. It wouldn't grow as strong as before. And another sort of concern with this macro environment would be that their provisioning or their NPLs, or non-performing loans, might increase. However, the banks have sort of provisioned enough to buffer throughout for future sort of unforeseen circumstances. And another reason why we don't expect such an increase in their NPLs or NPAs, so non-performing assets or non-performing loans, is that majority of the assets are in the ASEAN economy, and we are just seeing the rest of ASEAN opening up and reopening. So we won't really see such a big jump in the NPAs or NPLs in the economies which the three local banks are in. So hope that answers the question. Should I take any more questions? I think let me try to take a few more about the banks. I think they're quite far down. Give me a second to find it. I think majority of the upvoted ones are not the banks.
Okay, Terence, you want to take on some, if you can. I'm not sure you want to take on the capital land. I'm not sure.
Yeah, maybe I'll jump in while Glenn takes a look at some of the questions. Is Keppel's target price of $7.07 after or before re-rating? The target price of $7.07 is before the re-rating. The reason why we haven't priced in that re-rating is because we still see a number of hurdles that Keppel Corporation will need to clear, namely the EGM vote and some of the regulatory approvals as well. And that's why we have opted to keep our target price unchanged until they get. But we will revise our target price as they get these approvals along the way. I'll jump to the next question. Any negative impact on BRC and Pan United as a result of higher raw materials prices? So the short answer is no, because most of these higher costs will be passed through to the consumer, and there's the variable pricing in the contract for HDB that they can actually pass over. Also, another note, some of these raw material prices have been trending downwards, especially in the second quarter. So that will actually provide a positive uplift to both BRC and Pan United. We also want to note that despite the rising raw material prices, both BRC and Pan United have been making profits and also distributing healthy dividends for both companies. I'll probably just take one more before I hand it back to the rest of my team. No, I think that's the other more higher upvoted questions. So I hand it back to the rest of my team.
Okay, thanks. So I will try my best for this capital land investment. Sorry, I'm not ultra familiar with it. That's why I'm a bit hesitant to answer this. But anyway, besides CDL, what do you think about capital land invest? So let's say we're transitioning analyst. So for capital land invest is, I think for me, this is a bit more of a longer term theme to play, because ultimately you're buying into the premise that they can build a fund management arm. So for us, in the near term, they should still do well, because inside it, there's also service apartments, there's also retail. So I think it will do well, but underlying the thing is that you ultimately still need to believe that capital and invest can build up their fund management arm. Yeah. So sorry, it's probably not the best answer, but just that I'm not utterly that familiar, and we are transitioning analysts. So probably in the next briefing, or we can definitely give you a better answer to the one that I just gave you. So I'll move on to the next one. I counted 12, 13 stock picks. What would be your top pick? Perhaps 3 among them. So I would just ask each of I will give one, then maybe Terence can give one, and then Glenn can give one. So I guess if I'm talking about longer term, my topic among those that were under me will probably be HRNet. I think because it's one of those very few companies that has a very strong business model that can keep on generating capital. They can just generate 60 million cash flow every year, regardless of the cycle. Of course, there'll be bumps along the way. And they are not just a Singapore-centric company, so they can continue. And they got like 300 million balance sheet. Yeah, so that's one of those that we don't see many challenges for them. I mean, don't see the competition because they are so huge, right? That's why they can earn such high ROE. So we continue to see them to grow larger and larger, especially in the region. So that would be my I guess the pick amongst my stocks for the longer term. Terence and Glenn.
I think I'll go first. Yeah. So my pick would be Silver Lake. So I mean, as I mentioned earlier, why we like Silver Lake mainly is because currently, all the banks use they have this core banking system. So Silver Lake provides this core banking system, and they have this new banking platform. It's called Mobius. So they are able to consolidate all of their products. A bank is able to consolidate all their products. And one of the good things about this Mobius banking platform, which is I think it was launched in 2020, so it's quite new, is that it can coexist with almost all existing core banking software. So they don't need to have a core banking software that is with Silver Lake to purchase and use this Mobius platform. And we see this as one of the propellants to grow and for Silver Lake to push for more orders. And the second reason also is because they have shown that they have quite a stable recurring revenue. So the graph earlier, there was the maintenance and enhancement revenue. So this is their recurring revenue. So basically, whenever a bank comes to Silver Lake and they want to upgrade anything, they would have to this contributes to their recurring revenue. So they have no choice, but they have to go back to Silver Lake to ask them to maintain or to enhance it to include the new products, digital products that are coming in. Yeah, so these are one of the two main reasons why I feel that Silver Lake is a good pick. I think I hand over to Terence for his pick.
Yep, thanks, Glenn. In terms of our topic, even though Keppel Corporation is in our absolute 10, but for us, for the topic, it would be BRC Asia. The reason for why not Keppel is because Keppel, there's still a little bit of regulatory uncertainty. Some of the relevant approvals that they need to get is we think if they get the approvals, there'll be significant upside from the re-rating. But one of the more safer topics would be BRC Asia, and BRC Asia is a direct beneficiary of the construction sector recovery at 6 times earnings for FY22. We think that the downside is relatively capped and is compensated by 8% dividend yield as well. So we believe the uplift in the overall construction sector demand and the recovery will also benefit BRC Asia, given that they have 2/3 of the market share. So it will just benefit from the recovery in the sector as a market leader. Yep. So that's all for me. I'll hand back the time to Paul.
Okay, thanks, Terence. I'll move on to the next one. Is it a good time to average down on S&P, given that he has already come down quite a lot from his peak? I can't give you the absolute level whether it's bottom or not, but I guess when you're buying something that has corrected 30%, it's already kind of de-risked a lot. So a lot of bullish expectations already kind of been flushed out from the stock. So I think in general, whenever you buy something that has dropped quite a lot, the underlying asset that you're buying has really de-risked quite a lot. And if you're doing a consistent averaging, mathematically, what it means is that you're buying more when the prices are down. So I think this may look like, because I don't really cover US, but I guess it is attractive in general whenever, a lot of the excessive expectations have already been kind of cleared out from the market. Everybody knows recession is already flagged out everything. And what I'm trying to say is there's a lot of pessimism in the market. So any bullish scenario that could come up could actually reverse the market turn around the market quite strongly. So I do think that it's a good time to also average down. Yeah, sorry, because it's US market, so I don't really cover that. May I know the prospects of Yang Zhejiang and Yang Zhejiang Financial Service? For Yang Zhejiang Shipyard, again, we don't cover, but I'll just give you, since those that we attend briefings like Wilma, Yang Zhejiang, we can give you a bit more insight. Like those like Capital, I don't really attend, so I can't. But at least for Yang Zhejiang, for me, I'm a bit more careful with it because you can see that the freight rates are already coming down. So regardless, do know that shipping is still a very cyclical business. So I'm a bit more hesitant because when rates are coming down, you know that eventually the shipping cycle really looks quite elevated. So the ordering, the best time to buy is when there's not much orders. The worst time to buy is when the orders have kind of peaked. So I'm a bit more careful. For Yang Zhejiang Financial, what you're going to see for them is that they're trading now at 0.4, 0.5 times book. A lot of this book is going to be in cash. So they could be trading at cash or almost quite near cash, because what is happening is that for Yang Zhejiang Financial, a lot of the book, that means the assets has been in China for maybe 1 year loans. So what they're going to do is they might shrink that portfolio and bring it down to Singapore. The short-term thing is that they're going to hold a lot of cash, use it to buy back shares. But the problem is that the earnings, very high chance the earnings is going to drop because they're going to unlock all these assets that could be earning 6-7% roughly in China, then bring it down to Singapore, invest in PE, which is going to take a long time before you actually catch any earnings. So earnings is going to be weak, but just that you're going to have a very nice balance sheet for Young Traders Financial. Okay, I think in view of time, we'll just take the last three. What is the reference timeline for target price? We usually do it on a 12-month basis. It's always rolling 12 months. Yeah, for our target price. Hi, Paul, in your absolute 10 portfolio, why do you hang on to Asian Pay TV when it has not been performing? Okay, so this is the problem with having too much transparency when you don't do well. Okay, but anyway, the reason why we like Asian Pay TV is mainly because of the yield, and we think the yield can hold well because the 8% dividend yield is based on dividends of 18 million, and they generate cash flow about 60 million, free cash flow. That means after tax, after not the EBITDA, no fake cash flow. So it's the real cash flow because they clear this is after interest. The other reason why we're waiting is because we also want to wait for the 4G revenue to kick on, the backhaul revenue to kick on. That's why we still leave it there in our model. Maybe when that comes in, then we might take it up because because management continues to guide that they're going to get it. And I know they're quite conservative management, so we still think they're going to get that 5G backhaul revenue. Okay, I think we hit 12. So I think in view of that, we will try. I know some of the REIT questions they are just that we are in between REIT analysts, so that's why I'm a bit hesitant to answer because I'll probably give you the wrong answer anyway. So we're going to hold back a lot of the REIT questions, and you can send us an email, and hopefully when P3 is up, you can actually just post it in our P3 community app, and then we have no choice, we have to answer you. Okay, with that, I think I will hand it back to Roshan, and before that, I'd like to thank everyone. I hope you have a good long weekend break and really appreciate everyone's time you spent with us. I mean, it's almost 2 hours, so really appreciate. Thank you so much.
Yeah, thank you for the insightful presentation. We have now come to the end of the webinar today, and we would like to thank you all for joining us once again. For the upcoming Saturday, we will be sharing the outlook for US big tech market, as well as the Hong Kong and China market. Remember to mark your calendars. It's the 16th of July from 1 p.m. to 3:30 p.m.
Okay, thanks everyone. Bye-bye.
For the session just now, we will be uploading the recording on Phillip Capital's Facebook page and YouTube. You may view the recording of the webinar on your own time. Also, we have many other interesting webinars going on almost every other day. You may view our full list of free webinars on our website. Do take your time to fill in the survey so we can improve your experience with us in the future. You may scan the QR code or copy the survey link posted on the chat tab. You may also join our investing communities to get free access to full research reports and discussion on technical analysis. Once again, thank you all for joining us, and we hope to see you next week. Take care and have a nice weekend.
Bye-bye, everyone. Thank you.